Let's begin with the filing requirements for the Federal Estate Tax Return, Form 706. You must file this form when a decedent's gross estate plus their lifetime adjusted taxable gifts exceeds the basic exclusion amount for the year of death. For exam purposes, think of this threshold as a very high number, currently over $13 million. The key here is gross estate, which is a major testing area. The exam will try to trick you into thinking the gross estate only includes assets passed through a will. This is incorrect. The gross estate is a wide net that captures everything the decedent owned or had an interest in at death. This includes real estate, bank accounts, investments, and personal property. A classic exam trap involves life insurance. If a decedent held any incidence of ownership in a life insurance policy on their own life, such as the right to change the beneficiary or borrow against the policy, the full death benefit is included in their gross estate, even if it's paid directly to a child. Imagine a decedent with a $2 million home, $3 million in stocks, and a $10 million life insurance policy payable to their daughter, where the decedent paid all premiums and retained the right to change the beneficiary. Their gross estate isn't $5 million, it's $15 million, triggering a Form 706 filing requirement. Once the gross estate is determined, certain deductions are allowed to arrive at the taxable estate. These include funeral expenses, administrative expenses to settle the estate, and debts the decedent owed at the time of death. The exam will test whether an expense is reasonable and necessary. A lavish funeral might have its deduction limited if it's deemed unreasonable. The most significant deduction is the unlimited marital deduction. Any amount passing to a surviving spouse is fully deductible, provided the surviving spouse is a U.S. citizen. This is a critical point. If a decedent leaves their entire $20 million estate to their non-citizen spouse, the unlimited marital deduction does not apply, and the estate could face a substantial tax bill. The exam loves to test this citizenship requirement. Another key concept is portability. This allows a surviving spouse to use any of the deceased spouse's unused estate tax exclusion. This is called the Deceased Spousal Unused Exclusion, or DSUE. However, to secure this DSUE amount for the surviving spouse, the executor of the first deceased spouse's estate must file a Form 706 and make the portability election. This is required even if the first estate is well below the filing threshold and owes no tax. An exam question might describe an estate of $6 million and ask if a 706 is needed. If the goal is to preserve the unused exclusion for the surviving spouse, the answer is yes. A timely filed return is absolutely necessary to make the election. Speaking of timely filing, the deadline for Form 706 is 9 months after the decedent's date of death. A 6-month extension is available by filing Form 4768. Memorize this 9-month deadline. Finally, be aware of the Generation Skipping Transfer Tax, or GSTT. This is a separate tax on transfers to skip persons, typically grandchildren, and it has its own exemption equal to the estate tax exclusion. The exam will expect you to recognize that a direct transfer to a grandchild could trigger both estate tax and GSTT. For a mental shortcut, remember this phrase: gross up, then deduct down. First, you must capture everything to calculate the gross estate, including tricky assets like life insurance. Only after you have that total number do you deduct downward with expenses, debts, and the marital deduction. Don't let the exam confuse the order.